morning, everyone. Hello. Can we start, please? Today we need to do three things. The first thing is, since we haven't managed to finish last week, I will highlight the most important things you need to know in terms of theory of capital structure. Okay? Then we are going to discuss dividend policy of firms, and by the end of today's meeting we will go through revision, but this will be very brief and quick go through. Okay? So, right, what did we speak about last week? Last week we spoke about the cost of capital and the capital structure. Okay? And we started by discussing the way we calculate weighted average cost of capital, and then we were supposed to discuss the theory of Modigliani and Miller. And I asked you to read at home what the theory of Modigliani and Miller is, and I still uphold this. Please read about it, okay? But today I will just direct you to the most important things you need to know in terms of the theory and in terms of explanation of debt policy, okay? So what you need to know is shown on the slide, okay? You need to understand that by manipulation of debt policy, by changing capital structure, we can affect the value of firm. How can we do this? Let's have a look at the first graph. Okay? The first graph shows us the relationship between return and the capital structure. Just to remind you, when we go to the right, we increase the amount of debt in the capital structure. Okay? So in here, we may assume that a firm has 100% of debt in the capital structure, meaning that all operations of a firm are financed by debt. It doesn't matter whether this is bank debt or bonds. And close to y-axis, we have a situation when company finances itself only with equity. Okay? And this was what we spoke about last week. We said that the cost of equity increases with amount of debt. And why was that the case? We said last week that this is the case because shareholders are afraid of debt. When they see that the company has loads of debt in the capital structure, they are aware of the fact that the company may collapse, that the company may fail on paying interests, right? That's why, since they perceive a firm as more and more risky investment, the more they move to the right, they demand greater return. They demand greater return because they face greater risk. Okay? Cost of debt, on the other hand, is stable, because we are facing some advantages of debt. We know that interests on debt are tax deductible. However, by the end, the line increases as well slightly, and this slight increase indicates on the graph that costs of financial distress affect the amount of debt we have in the capital structure as well, and affect the cost of debt. Okay? And here was the thing we discussed during the tutorial, our weighted average cost of capital. So our single figure that represented the cost of capital, the cost of financing a firm has in its own structure, okay? So all costs weighted together would provide us with weighted average cost of capital. And now, the most important thing, from a firm perspective, we as managers, we would aim at minimizing the weighted average cost of capital. So ideally, we would like to end up in a situation when weighted average cost of capital is the lowest. And that would cause the value of the firm to be the greatest. Okay? And this is what is shown on this graph below, where we have a relationship between value and again the relationship between debt and equity. We need to find an optimal point where weighted average cost of capital will be the lowest. So we would like to have as much financing as we can, but balance the costs and benefits of debt, costs and benefits of equity in a way that we minimize the weighted average cost of capital. Okay? So this is the second thing that you need to know from last week. From last week, you need to also understand what factors affect the weighted average cost of capital and why this line is not straight, why it is not a linear relationship. Okay? There are quite a few of them, and we've got the list on the slide, okay? But the most important one is the cost of financial distress, which I mentioned already, okay? So the more debt we have in a firm, we may face a cost of financial distress or a cost of bankruptcy, okay? And when we move to the left, the benefits are that there is a tax relief on debt, and that's why this line is moving upwards in here. There is something in here which is called agency cost. What do we mean by agency cost, and why does it cause an increase of weighted average cost of capital? It causes the increase of weighted average cost of capital because the more constrained the firm is, okay, the more risky it is to default, the more expensive it is to run the firm. Okay? When you take a textbook, please read about the remaining factors. We mentioned them to some extent during the lecture, but these are the ones that you should be aware of when being asked about how weighted average cost of capital is being shaped. What sort of forces indicate the level of weighted average cost of capital? Okay? And that's really about it with regards to debt policy. And that's about it when it comes to the theory of debt policy, okay? Let's move on to dividend decision, our main topic for today. So, what are these dividends? And how do we learn dividend when we analyze a firm? Okay? Normally, when you look at financial statements or reports of a firm, firms state in their financial reports that they distribute dividends, right? And more or less they indicate how do they do it. So they may say that, right, we pay 40% of our retained earnings to our shareholders, full stop. And they may also add that this 40% increases by CPI, for example, every single year. But they don't provide details on how they decided how much dividend they should pay. Okay? This is something that is a question of many researchers, it's a question of many academics like myself. We try to understand how do firms decide on dividend policy. Okay? There is loads of interesting articles about it, and I think the most interesting statement was drawn from Warren Buffett. Okay, you know who Warren Buffett is. He's a prominent investor who makes loads and loads of money by playing on the stock market. And he was asked about his opinion about how do we decide about dividend policy, what investors or what managers have in mind when they say that, okay, let's distribute 40% of our earnings to shareholders. And he said that with his observation, he thinks that it's a really vague decision. people consider some factors, consider their future prospects, but they either use rule of thumb or take it quite randomly. There is so much vagueness when it comes to deciding on how much dividend a company should pay. But we will try to approach this topic a little bit theoretically. We will try to identify factors that actually affect this decision so that we can understand how firms decide more or less about how much earnings they should pay to their investors. Okay? So we are going to go through the following things. We will start from cash dividends. And as a standard method of paying out the earnings, we are going to discuss the price behavior about around the date that dividend is actually incorporated into prices. Then we are going to have a look at, again, Modigliani and Miller, and we are going to show that dividend policy can be perceived as irrelevant to the firm value. Okay, so we will talk about the situation where if we make some assumptions, it doesn't really matter what sort of dividend policy the company undertakes, and it would not have an effect on the company value and therefore the share price. And then we will close by discussion on alternatives to cash dividends. So we will talk about stock splits, special dividends, and stock repurchases. Okay? So right, what is the dividend? The dividend is, as I said, is a distribution of after-tax profit. Okay? The important things are that this profit must be taken from capital. Okay? We shouldn't be taking loans, or firms do not normally raise extra capital in order to pay out the dividend. It should be taken out of capital. Okay? And normally they are paid every 6 months. When the first dividend a year is normally smaller because firms are uncertain whether they would be able to pay the second dividend. Okay? This is obviously restricted because since it is an action on the stock market, the Companies Act from 1985 regulates how do we actually pay dividends and how they should be announced, what are the procedures. Okay? It is stated in the Companies Act that whatever that dividend is decided by the boards of directors, shareholders have a right to reject. Okay? So shareholders have a say on how much dividends are being paid. And they, well, dividends, when being paid out, they are restricted by all the agreements that a firm has with its shareholders or debt holders. Okay, so dividends, since they are paid out of capital, must consider how much debt do we have in a firm. So they must be incorporating all our monthly agreements. Okay, so only after the debt is being paid, the bonds are being paid out, then we consider the dividend to be distributed. It cannot be the case that a firm fails on, for example, debt payments and still pays out the dividend. Okay, dividend is not the first resort in here. So what sort of thing do we observe when the dividend is being paid? There is quite a lot of different vocabulary that appears in dividends literature. Okay, so imagine that this is a situation when a company decides to pay a dividend of £1 per share. Okay, this is our time frame that we observe. Okay? And now, somewhere at, let's say, day 0 or day -2, a company announces that they will pay dividend. Okay? What market does, on the basis of whether it is a big dividend, whether it is a good news, or whether it is reduction of the news, a market reacts to this. Okay? So the market reacts to the announcement as to every single announcement of earnings or different changes to a firm. The same thing is with dividend announcement. Okay? So the first dividend is being announced and the news is being incorporated into the price. And it takes normally a day or two to incorporate the price of dividend into the dividend, into the stock price. Okay? So as in our example, if a stock price was £10, until the ex-dividend date, it remains £10. On the ex-dividend date agreed by the board, the stock price drops by the amount of dividend. And why it is the case? It is the case, and you should understand that if you get rid of a stock after the announcement, you are still entitled to the dividend. If you buy a stock after the dividend announcement and before the ex-dividend date, you cannot get the dividend. The dividend is normally paid out to a person who held the stock on the dividend announcement. Okay? This drop is always equal to the amount of dividend per share, and dividends are normally distributed via cash to shareholders, so they enter their accounts or they are paid by checks. Okay, so this is really cash going to shareholders. This picture is a little bit misleading, in a sense that this one doesn't show us the intrinsic value that changes. Okay, this is what is shown in here. This is the stock price of Microsoft. Okay, it is from 2004, so this is a very old piece of information, but this is at the very beginning of times when Microsoft started to paying dividends at all. They didn't pay dividends up to 2003, and from 2003 they started paying dividends, but it doesn't really matter when it comes to this graph. Okay, here we can observe some sort of volatility of a stock price before the drop. Okay, you may be thinking that, okay, this is a discontinuation of a security, but it isn't. It is just the fact that at this very day, 12th of November 2004, Microsoft paid out the dividend, and we can actually tell how big the dividend was when we look at the y-axis, right? We have a price of stock in millions in here, or the market value of Microsoft in millions, and we can say that they paid about $2 million to their shareholders via dividend in here. Okay, and that's why the price was adjusted. A part of a firm was paid out to shareholders, and therefore it shouldn't be incorporated into the market value anymore. That's why the stock price falls down by the amount of dividend. Okay? So when we look at longer period of time, we can actually understand that obviously this is, well, dividends being paid are not the only news that affect the share price, right? the share prices are normally very volatile. They are affected by number of different factors, but dividends, being regular, reduce the price every single 6 months or every single year to the same extent. And now you need to understand that it is very important for firms to keep dividends stable, okay? To keep this dynamics on the market stable. Investors normally do not like dividends being changed. So if a company decides to pay out 20% of dividends every 6 months, that's what they should be doing, or that's what they keep on doing. They don't change the dividends very often, and this is called dividend smoothing. Okay, firms do very best to keep the dividends on track and to keep them stable, keep them in the same amount. Okay, so once we understand how market behaves around the dividend announcement, we should understand how these dividends and how the fact that firms pay dividends and to what extent do they pay them, what is the size of their dividends, what is their really dividend policy, how does it affect a company value, or whether it may not be the case, maybe dividend policy doesn't affect the company value at all. Okay? So the first argument, as with leverage and as with capital structure, the first argument is proposed by Modigliani and Miller, and they obviously argue that no, it doesn't matter what sort of dividend policy a company pays. Okay? They can pay whatever they want. That's what they say. And they made this statement long time ago, 50 years ago, when only cash dividends were available. Okay, so they weren't really aware of stock repurchases that we are going to discuss later on. So this is a situation where they consider only cash dividends, okay? And they made certain assumptions, which you should be familiar with. They appeared when we talked about CAPM, when we spoke about leverage, okay? So we are assuming that there is a perfect market in order to understand Modigliani and Miller argument. So we need to assume that there are no taxes. We need to assume that it doesn't cost anything to borrow money or to issue shares, okay? We need to assume that investors can borrow and lend at the same rate. And it doesn't matter whether it is an individual or a company that borrows funds. Bank would borrow the money at the same rate. And that everyone knows everything about firms and their actions. Okay? And Modigliani and Miller, I know it is tough, but they argue that there is only one thing on which depends a value of a firm. And this particular thing are the firm's investments. Okay? So this is only investment policy and investment choices that affect company value. And it doesn't matter what sort of capital structure a company has or what sort of dividend policy is implemented. The only thing that is important is that a company would pay or would choose to invest in all available projects with positive net present value. And this is what can be explained using this graph. Okay? Modigliani and Miller say that if the main determinant really of firm value is their decision to invest, okay? And the main choice that the company should be making is that the present value of a firm, present value of investment should be positive, and the cost of the investment should be greater than the cost of equity that is implemented. Full stop. Okay? So in here, if we were to decide, and if we have amount of funds on x-axis in here, okay, and a company, let's say, has funds from 0 to A, then what they should do, they should accept the 3 projects, project 1, project 2, and project 3. And the return on these projects would determine the company value. And it doesn't matter whether the rest of the money that company has is paid out or not, because it will not affect the company value. That's what they say. And they say that because they assume that a shareholder can go to the stock market and buy shares of a different firm in case they want to get more funds, okay? Or on the other hand, if they want to have some cash in hand and they don't want to keep their money in a firm that invests in project 1, 2, and 3, they can just sell their shares on their own and create the dividend themselves by selling the share. That's what this theory of dividend irrelevance says. Okay? But we should be also able to understand the opposite situation where capital is really expensive. Okay? Just imagine that we forget about the assumptions of Modigliani and Miller, and now we think that it is really expensive to issue debt and to issue equity. Okay? And imagine that, again, on this graph, a firm has funds from 0 to P. Okay? The investment decision that they are making is still the same. They should be accepting all the projects which have internal rate of return greater than the cost of equity. Okay? So again, decision to invest should be to invest in project 1, project 2, and project 3. And why it is the case? It is the case because projects 4, 5, and 6 generate internal rate of return lower than the cost of equity. So they wouldn't be able to pay for the cost of financing. So if a firm has funds from 0 to P and invested in project 1, 2, and 3, then from A to P should be distributed to investors. Okay? Investors should get from a company the amount of money equal to AP. Okay? Why they would have to get it? They would have to get it because otherwise the money would be wasted, or the money would be invested in project 4, which doesn't provide them with sufficient return. Okay? So if we consider dividends as residuals, then everything that is not generating net present value, that is not generating positive net present value, should be distributed to investors as dividends. Okay? And in this way, investors would be able to identify different firms when they can still invest their money and still generate a sufficient amount of return. Okay? So these are the two abstract theoretical models. Okay? But what about the reality? Okay? How do we actually decide on dividend policy when it comes to our world? There are several factors. that we should consider. And the factors are listed on the slide. Okay? So, in difference to what the theory says, we have got taxes. Okay? And we pay different taxes on capital gains, and we pay different taxes on dividends. Okay? So if a company decides on the dividend payout, they should see what sort of investors do they have, and what investors would they like to attract, and consider their tax abilities. If these are, for example, individuals, they would have different tax requirements than if these are financial institutions, okay? Because we normally pay tax on dividends progressively. It's normal progressive tax. As we pay on every income, we would pay on dividends, okay? And the tax on capital gains is lower. There is a limit up to 8,000. Alex, would you know?
Tax-free.
Tax-free capital gains.
11,000.
11,000 at the moment, right? So we do not have to pay tax on capital gains up to 11,000 pounds, which for individuals is quite attractive, right? So when a company pays out dividends, these are the things that they should consider. First, tax. Then some restrictions, like, as I told you, it is very important for a company to keep dividends stable, because every change to dividend policy sends a signal to investors, which I'm going to explain in a minute. Okay? And another thing that needs to be considered is the desire for current income. Again, we need to understand, when deciding on the dividend policy, who are our investors. Okay? So imagine we have the largest investor, who is a pension fund. Okay? If we have a pension fund, then this particular investor would like stable dividends to be paid, so that they can pay out their commitments to their pensioners. If, on the other hand, we have aggressive funds in our as our shareholders, we wouldn't really care much about dividends, and we would concentrate on making greater capital gains. Okay? This decision on how much to pay dividends is really complicated, and there are several factors that we consider. And as we started, there were taxes, there were different investors that we should acknowledge. And one of these factors that decides or helps us to decide on dividend policy is signaling, okay? Every change to a dividend policy sends a signal to a market. So, since we know that every company would like to have a stable dividend policy, and then all of a sudden the dividend is being cut, what that may mean? Would you have an idea? What would it mean if a company which pays 20% every single year all of a sudden decides to cut down the dividend and pay, let's say, 10%? What would you guess is going on in the firm? Well, that's an optimistic scenario, yes, but it can be the case that a company needs funds to invest in something, and therefore they will create greater capital gains for us, right? But what is the normal reaction? A little bit more pessimistic. Why the company is cutting down dividends?
It's not performing financially well.
Yeah, it just doesn't perform financially well and cannot afford to pay out the dividend. Okay? And that's why, because of this reason and the automatic understanding of the dividend cuts, management doesn't really want to reduce the amounts of dividends. So even if there is a year of prosperity and a firm would be able to pay triple the dividend, they don't do it normally. They normally keep really precaution, and they normally keep the dividends at the relatively low level so that they can assure their investors they are paying stable amount of dividends every half of a year or every year. Okay? So the stability is really important. And every increase, on the other hand, as a counter-argument, if we see an increase in dividends, we can say that, well, a firm is expecting a growth in their prospects so that they should be able to afford paying this greater amount of dividend for a longer period of time. Okay? But there are funny situations, and dividends are a strange thing, because there was a situation around 2004 where all the IT companies started to pay dividends. Okay, as you know, in year 2000 there was a big technology boom when firms like Apple, Samsung, and all the IT companies started to be listed, okay, or entered financial markets. And at the very beginning, they didn't pay dividends because they were at the stage of growth, and they needed their money to invest in their development. And then, a couple of years later, around year 2003 and 2004, these firms started paying out dividends, right? And normal reaction of the market would be that if a firm pays out dividend, it means that it's a positive news, right? It means that the market should react positively to this. Why? Because it means that the company is really stable and therefore should be able to afford paying out dividends for many years to come, and everyone should be happy. But the market reaction was completely opposite in this instance. It was opposite. The prices of the IT firms that started issuing dividends fell down. And why would you think that was the case? Market understanding was that these IT firms ran out of ideas and that they won't have any further growth. And that's why they reacted negatively to it. And the prices of stocks were falling down, which really discouraged the IT firms. And this is what is happening at the moment to Apple. Apple has loads of cash, if you read some financial press, but they don't really want to increase the dividends for this particular reason, that then investors may think that, well, there is no Steve Jobs, there are no ideas, and perhaps Apple wouldn't do well for many years to come. Okay? So these are really interesting things that you may explore if you are interested for your dissertation next year, to observe really what sort of reactions are there to dividends, what sort of returns can we make with consideration of dividends earnings. Right, so other than signaling, there is one more important force that needs to be considered when deciding on the dividends. Okay? As I said before, when we pay out dividends, we should consider what sort of shareholders do we have. And this is called clientele effect. Okay? So imagine if we have in our firms pension funds or pensioners themselves, we should pay lots of attention to the dividend policy that we have in place, because these people or their income depends on our dividend payout. Okay, so there are some investors which really want dividends to be paid out because they need to pay their life from or pay their bill from the dividends that they receive. And if the dividend is unstable, they would normally sell the share of a company in as a whole, right? But there are some firms which are owned by young people who aren't, risk averse at all. They care only about capital gains, and then management of a company may have easier choice, or they may not really bother about about the dividend and the size of the dividend that they pay. The important thing is obviously to keep our shareholders happy, to maximize their wealth. And if we are to maximize their wealth, we need to know what their needs are. So if we are financial managers, we need to understand what sort of shareholders do we have. So this is really the summary of this whole argument. If we are to sum it up, there are so many forces that influence the dividend decision or influence the amount of money that is paid out to our investors. Okay? So we can be encouraged to pay out high dividends if we consider investors who need stable level of income. If we consider signaling, then we would like to see high dividend payouts so that there is a signal sent to the market that there are good prospects for the firm. Okay? And this can be discussed really widely, whether the dividends should be stable or low or fluctuating, considering all the factors listed on the slide, and of which most we already discussed. Okay? Before we move on though, could we have 10 minutes break, please? Okay? And we will continue after 10 minutes. Thank you. Can we move back to lecture, please? Hello? Okay, guys. So, as a roundup of arguments, okay, during the first part of the lecture, we tried to address issues related to a question whether shareholders' wealth or the company value can be affected by dividend policy. Okay? And obviously, the answer to this question is that yes, it can be affected, but there are so many different factors that affect the dividend policy that it is really difficult to imagine one person building a model that would incorporate all of these factors into decision making, whether and how high the dividend should be. Okay? We are familiar with the dividend growth model presented in here, okay, which tells us, and which, as we practice during tutorials, tells us that the value of the firm depends indeed on the dividend price. Okay? So this is opposite to what Modigliani and Wheeler argued. This is opposite to the residual theory. It is really simplified version of what we have in the reality, but it underlies the importance of the dividends. Okay? Have a look at this model and just think what sort of assumptions we have to make in order for this to hold, or in order for this to be true? What sort of things we have to assume about dividends and their growth? Can you remember? What sort of things did we have to assume, or what do we have to assume about the dividends and the growth when we apply the dividend growth model to valuation? The growth must be constant, right? The growth must be constant, and therefore the dividend has to be to some extent linear or constant as well, right? I distributed today handouts with one question at which I would like to look with you right now. Okay, so let's have a look at the question. Okay, so we have a firm that has the following dividend per share history, and we are provided here with the information about dividends per share paid over the past 5 years. Okay, we also know that the risk-free return on government securities is currently 6.5%. We know that the risk premium for shares above the risk-free rate of return has been 5% per annum, and that the firm is in risk class of shares, which suggests that the average risk premium of 5 should be adjusted by beta equal to 0.9. The company's dividends are expected to continue their historic growth path that has 100 million ordinary shares in issue, with a total market value of 190 million pounds. And we are asked to use dividend valuation model and state whether the firm's shares are good buying opportunity for stock market investor or not. Okay? So, coming back to our slide and looking at the dividend growth model, where would you say we have to start in order to address this question, in order to state whether shares are a good buying opportunity or not? Where from do we start? Pardon? Yes, we need to find the growth. Really well done. We need to find the growth of dividends per share. Okay? And the purpose of this exercise is to show you how the dividend growth is being calculated. Okay? And how limited, therefore, this model is. In order to find the growth of dividends, what do we have to do? Do you have any idea? How can we address this in this question? Can you tell what's the dividend growth rate? We know what are the dividends per share. But we can see that they grow really at different rates, right? Normally what we do, we use the exponential growth formula. Okay? And this is something that you need to revise from mathematics class, I assume. Okay? So in order to find here the growth rate, we need to find an exponential for 5 years, because this is the amount of years we have information for. Okay? And we need to take the dividend from year t and compare it to the dividend in year 5. And why do we do it? This is just being done because we have limited tools, okay? We have limited tools when it comes to valuation. And as you can see, in this case, as in many firms, the dividend varies from year to year a little bit. And sometimes we may not have a stable growth of dividends. But we know the historical values, as we do in here. And we can see that there is some rate of growth from year to year, but we do not have it stable, okay? So our task here is to find what the growth rate should be from year to year, using the information provided. So what we need to pay attention is the dividend from this year, which is 5.4. And the most distant dividend that we have provided, which in here is 3.38. And this is the observation of 5 years. And this is the way we should be approaching identification of growth. So we need to identify the largest amount of years or of the largest amount of data that we can, okay? And on the basis of long period of time, we would like to find, obviously this one's one. We would like to find a growth rate of dividends, okay? And in this example, you should get 9%, 9.82%. Okay? So if we had 10 years of data, and if we were to find the dividend growth rate, you shouldn't be checking from year to year and identifying the most common growth between years, but you should follow the procedure of exponential growth and have a look at the most distant dividend and the closest dividend, and look at the number of years that passed in between the time, okay? Right, so once we know the growth of the dividends, what would be the next step? Go on. The rate, the expected rate of return, right? When we look at the dividend growth model, we need growth, which we identified, it is 9.82, and the next one is the rate of return, the required rate of return by investors. How can we find the required rate of return? Using the information provided. From dividend growth model we could, but we aim to use dividend growth model for valuation. We can do it with beta, right? Yeah, well done, Florian. Right? We can do it with beta. Once you can see the beta in the example, you should know that you should be really somewhere you should somewhere implement the capital asset pricing model, okay? So this capital asset pricing model will be used to find the cost of equity, the required rate of return, okay? So how did we do this? We started from the risk-free rate. We used to start from the risk-free rate, and we added beta times return from the market minus risk-free rate. Okay? So what the risk-free rate is in this example? Can you identify the value of the risk-free rate? 6.5. It is 6.5. Well done, Jesse. It is the risk-free return on government securities. Here, 6.5%. Okay? Plus the beta. Do we have the value of beta? Say it again. 0.9. Okay? And now we need to find the market premium, or if we have the return from the market. And here we are provided with what? With risk premium, right? With risk market premium. So with the value that we have here in the bracket. So what is the risk premium here, guys? It is 5%. And how much cost of equity would we get out of here? How much? 11%. Okay. Go on. Yes. Is that okay, Iman? It is risk-free rate of 6.5%. Right? So we have our growth equal 9.82. We have our cost of equity equal 11%. What do we do next? How can we decide whether the company shares are a good buying opportunity for stock investor or not? What do we do next, guys? We go back to the dividend growth model, right? We need to find the price of a stock that we analyze. So we need to use the formula from the slide, this dividend growth model. Right? So what would be our price? We have our last dividend paid out, which would be how much? What was the last dividend paid in this firm? Guys, go on. No. The last dividend. We need to consider the dividend from the last year. 5.4.
Last year?
Yes, from the last year. From the one that has just been paid. This is the one that we should consider. So the one from the top of the table, right? Can you see? It is 5.4 pence. Okay? Times 1 plus our growth. And how much is the growth rate? Guys, 9.82%. Divided by our return. How much is the return? Huh? 11% minus 9.82. And that should give us £5 and 0.26. Okay? So we have our stock price in accordance to our valuation. Can we tell now whether this share is a good buying opportunity or not? What are we missing? Do we have to calculate something else, or can we already advise our investor? Any ideas? Huh? Pardon? Yeah, we can time it by the number of shares or find the share price that is provided in the question. We can do it both ways, right? So how many shares do we have? in issue? 100 million, right? So we need to multiply this £5 times 100 million. Right? So we should get something of worth 502.6 million. Right? So now we should be able to make the recommendation whether this is a good opportunity or not. Is it a good opportunity for a purchase of shares? Yes. Why it is the case? Why it is the case, guys? Why it is a good opportunity to buy?
The value.
Because the value should be greater than it is, right? So we can expect a growth in the price of a share. Do you have any questions regarding this exercise? No? Okay, then let's continue on with the lecture then. So the thing that you need to understand about dividend growth model is that, well, this is a tool that we use, but it has limitations, okay? It uses loads of assumptions that we need to consider before using the tool, okay? It cannot be applied, for example, to a firm that doesn't pay dividends at all, because if the company doesn't pay dividends, then dividend would be zero, and the dividend growth model would suggest the value of the firm be equal to zero, right? And we cannot use this for firms that do not pay dividends. We can only apply this to a valuation of firms which pay dividends at a stable growth rate. Okay? So let's move on to the last really element of our lecture regarding the dividend policy. Okay? And the last element that we need to discuss are alternatives to the cash dividends. Okay? There are different ways firms can distribute their earnings to shareholders. The one that we concentrated on was cash dividend. Okay? So investors can distribute cash among shareholders, or they can pay scrip dividends. And this is really important for you to understand. Okay? What are the scrip dividends? Scrip dividends are additional shares given to current shareholders. Okay? And this is something which is good for the company because it is not a commitment. Okay? With cash dividends, if we increase a dividend, we make a commitment. We make a statement that this dividend is going to be continued for many years to come. And if we have some extra cash that we would like to distribute to shareholders, we may issue shares for them or give them extra shares just one time. Okay? So just one time. Give them these shares and do not promise that we will do this every single year. So for example, if an investor holds 3 shares, let's say, we may say that for every investor who owns 3 shares, we will give 1 extra. And this is how scrip dividends work. It works well for a firm because the firm keeps the cash within their balance sheet. Okay. It makes an impression that the gearing or the amount of debt is lower because we increase the number of shares. Okay. So this is a very good tool that can manipulate a little bit our capital structure. And another thing, or another way, or another alternative to dividends, to cash dividends, are share repurchases. Okay? Again, this is not a commitment. This is not something that if we do it once, we are promising to repeat. Okay? So instead of paying extra dividends, extra cash dividends, we can make an announcement as a firm to repurchase stocks, our stocks. Okay? And this can happen in various different ways. We can just start buying stocks off the stock market as if we were investors, or we can approach particular investors, particular, for example, large shareholders. We can approach them saying and make a tender offer saying that yes, we will buy your shares at a premium. Okay? Or there can be an auction where we can state that we will pay some sort of a premium and we would allow investors to bid against our offer in order to get the best price. What I would like you to do at home and to try to understand is what are the advantages and disadvantages of these share repurchases. We will start our tutorial from discussing this issue. What sort of advantages are there when we repurchase shares in comparison to cash dividends? Okay? So please look at this at home so that we can look at this together during the tutorial. Okay? And there are also some different alternatives to cash dividends which aren't as popular as share repurchases or scrip dividends. Okay? Which are, for example, the benefits that firms provide, so that, for example, they may provide discounts on their services or their products. This is the way of distributing earnings to our shareholders as well. Okay? So in conclusion of this lecture, the things that we should understand, the things which we should be familiar with are the theoretical approaches of Modigliani and Wheeler, and what we should be able to do, or what you should be able to do. You should be able to explain why dividend policy may be claimed to be irrelevant in terms of impact on company value, okay? And you should also be able to say what sort of different factors should we consider when deciding on the dividend policy. There are a number of them that we discussed during the lecture and many more. But you should be able to provide, to some extent, a discussion on what sort of factors should be incorporated. To make your life a little bit easier for the revision, as with every single one of my lectures, this lecture as well closes with a couple of questions. These are sort of exam type questions which you again should be able to address when you revise your material towards the exam. Okay? So thank you for this. What we need to do today as well is to revise a little bit the entire module. Okay? In the meantime, what I would like you to do now is to take your phones, okay, and enter a website called socrative.com. Would you mind doing it now? Enter this website, socrative.com, and try to log in as a student. Once you do it, you'll be asked about room number, and I would like you to enter room number 487 376. Okay? I'm asking you to do this because during the tutorial I would like to go with you as a matter of revision via one topic, okay, that I would like you to choose. So what I would like you to do, I would like you to give me your answers or your suggestions with regards to the most difficult topic of the financial management class, okay, so that during next week tutorials we can revise it a little bit and clarify things which were perhaps more difficult, okay? Or we will solve one exam type question regarding this particular topic. Okay, I have just 10 answers. Can you please do it so that I know how to prepare for tutorials? 11. Right, I will look at this myself later on, but these are the topics. If in case you forget or you forgot what did you learn, if anything out of this is really difficult, please let me know. Okay? So, as a matter of revision, I should tell you what is the most important, right? Or which topics are the most important. Can I ask for your attention again, please? Okay. As you know, financial management is an accredited module, okay? So, if you are a student of BSc Accounting, BSc Financial Management, or BSc Accounting and Financial Management, and you pursue a career in finance or accounting, this module grants you exemptions. Okay, so if you pass it and decide to do ACCA, CIMA, or ICAEW, then you can request an exemption from this professional accreditation. Because of this thing, all of the topics we discussed are relevant for the exam, other than what we discussed with reference to Bloomberg, okay? So you need to know, or you should be able to know, what efficient market hypothesis was all about, how do we define perfect market, how the perfect market influences our understanding of news announcements with regards to prices. You should be able to use investment appraisal techniques with application of capital asset pricing model, with application of weighted average cost of capital, and with incorporation of risk, what comes with capital asset pricing model. You need to know how to value firms. You need to know how to value different securities, different types of bonds. As a limitation, I can give you a hint that you will not be asked to do anything else than irredeemable and redeemable bonds. There will not be convertible bonds on the exam. Okay. You need to know how to value equity using different methods. Again, dividend growth model and capital asset pricing model. You need to know what sort of techniques can we use to value mergers and acquisitions. What sort of mechanisms are there in order to defend from an attempt to be acquired? And how can we finance mergers and acquisitions? What sort of different ways of financing are there? Whether we can pay in cash, whether we can pay in stocks, there are different methods. Then you need to know things about risk and return relationship. So you should be able to measure the risk of a stock and a portfolio, and measure return of a stock and a portfolio. And you should be able to distinguish between systematic risk and unsystematic risk, which means that you should be able to understand capital asset pricing model and its assumptions. In what follows, there was debt policy. So what you are expected to know is how to calculate the weighted average cost of capital, how we can influence the weighted average cost of capital, and what is the relation between the weighted average cost of capital and value of the firm. Whether by adjusting the weighted average cost of capital, we can influence the value of the firm. And last, but definitely not least, there was dividend decision, which we went through today as a last topic. Okay, and again, you should know what sort of dividends are there: cash dividends, share repurchases, and all other alternatives. You should understand what the scrip dividends are and what do we mean by alternative dividend payouts. And you should be able to know how to find the exponential growth and how to value the firm with consideration of dividend payout. To give you a hint regarding the revision, of course, I assume that you read a lot the core text. If you didn't, it is available in the library. It is available also as ebook, so it means that you don't have to buy it if you forgot to do it. With regards to discussion questions that may happen on the exam, these would refer normally to lectures and the material covered during lectures. All the calculations would refer to tutorials. Okay? So if you start your revision, start from the lectures and practice the calculations we did during tutorials. Okay? Please don't start from a thing which is not even mentioned on this slide, which is past exam papers. Okay? I uploaded 3 of them on your request, but I don't really think that it is the tool that you should use for your revision. Okay? The reason is every single year we concentrate a little bit on different aspects, and exams change every single year. So if you do revision on the basis of exam from, for example, exam 2015 and have a look at exam 2014, you will see that there were different questions, and it doesn't give any indication with regards to what is going to happen on the exam next year. Okay? So my golden advice: practice tutorial questions and lectures, not past exam papers. Right, I was informed that the exam will take place on the 15th of January at 9 a.m., but please change this date after the Christmas break. It may happen that this timing will be adjusted as it happened during this year, so please be aware that this should be checked by you after the Christmas break, okay? So, the exam will last 3 hours. There will be 6 questions as last year. You will have to choose 4. Please answer these 4 questions fully and address all the requirements. Every single question is a combination of calculations and some discussion. Normally you are asked to provide some sort of advice, whether investments should be accepted, or whether the stock is undervalued, or whether cost of capital is too low or too high. As I said, sample examinations and solutions are provided on eBridge. If you would like to see more exam papers, they are available on in digital repository, also online. Yes, I've said about the timing, that these are draft and subject to change. This is what we are being advised to tell you by the university, so please be aware of this. During the exam, you will have a list of formulas, okay? The list of formulas that you will have on the exam is exactly the same as the one presented in your module handbook. So if you would like to have a look, please refer to module handbook. I will double check today in the afternoon if this version of formula sheet is exactly the same to the one you are going to get on the exam. As you will see, some formulas aren't there. Like, for example, weighted average cost of capital formula is not there, but it absolutely doesn't mean that there won't be a question regarding weighted average cost of capital. As I tried to explain during tutorial, weighted average cost of capital is something that important that you need to learn. Okay? The same thing is with net present value or with equivalent annual cost. These are the things that aren't there on the formula sheet. These are the things that you should know, okay, as individuals. So please practice at home. You may try the formula sheet provided in the module handbook as a matter of practice, okay? Important thing, calculators. Last year, and I think a year ago as well, there were cases where students brought calculators which had USB entrance. Unfortunately, if someone sees that you have that advanced calculator, which is financial calculator normally, you are unfortunately taken to unfair means panel. And that means that the marks are reduced to 0, and this is really unfortunate. So please check that your calculator that you are going to bring to the exam is really simple. It doesn't have any USB entrances. It doesn't connect to Wi-Fi or anything, all right? It is simple, old, traditional calculator which will not expose you to invigilators, okay? This is important, and it has consequences if you bring a new one. Now, questions. Please don't ask me via email to solve exam questions for you. I don't do it. I provided several exam papers on eBridge, and I do not intend to solve more questions from past exam papers. I'm available for all your inquiries during my office hours next week, which are on Wednesday between 1:30 and 2:30, and my office is in Wharf Building in office 226. I will also be available just before the exam. Please make a note. I will be available in my office on 13th of January between 1:30 and 2:30 again. So if you have any last minute questions, please come and see me, and I would be more than happy to help you. Other than that, thank you very much. I enjoyed very much teaching you. You were a really great bunch of students. Thank you. I really hope I won't see you next year, so please do your best during the exam, okay? And good luck. Thanks.